How would reducing income tax benefit the country and the economy? The common argument for reducing tax or getting rid of it altogether is that it's pro growth. It's common sense. When individuals and businesses pay less tax, they have more money left to invest and spend. That should mean more people buying more things, more companies hiring more jobs, and generally a faster growing economy, leading the government to collect more tax revenue. We did see some of these effects following big tax cuts in the past. The Tax Cuts and Jobs Act in 2017 was followed by a surge in job openings. Job availability jumped by more than 1 million open jobs in the year following the tax cut. We also saw evidence of increased economic output following the tax cuts at the end of 2017. Actual measured GDP in 2018 well surpassed the CBO projections. In the second and third quarters of 2018, GDP was about $290 billion higher than the CBO's most optimistic projections. GDP growth then slowed in the final quarter of 2018 and 2019 as trade tensions with China increased. And that's the catch. Trade tensions and tariffs are not pro-growth. In fact, they slow growth. Consumer spending could see a 1 to 2% drop in growth in 2026 with tariffs, according to forecasts by Deloitte. That big drop in spending would weigh down the economy. Deloitte also projects that GDP growth will decline over the next few years as a result of reduced consumer spending. That being said, there is a potential upside to tariffs. They're designed to make the economy less dependent on other countries. Higher import taxes incentivize consumers to buy local and spur companies to build factories and create jobs in the US. So if tariffs do replace income tax, who are the winners and losers? The companies hardest hit by tariffs will likely be those who rely heavily on foreign manufacturing and foreign markets. Think companies that trade in hard goods, made largely overseas, particularly in China, like Apple, Nike, and Walmart. These companies are vulnerable to tariffs and will feel the pain on their balance sheets until they can rejig their supply chains, or score tariff exemptions like Apple has for smartphones, for now at least. It's not just manufacturing, though. Many American companies depend heavily on foreign buyers, and reciprocal tariffs from other countries will likely hurt those sales. For example, around 40% of revenue for the S&P 500 companies comes from outside the US.